afternoon, everyone, and welcome to our 6th annual Tech Outlook. For those of you attending your first program with the Exec Club, my name is Margaret Mueller. I'm the President and CEO of the Executives Club of Chicago. Before we get started, I'd like to take a moment to thank all of our sponsors for the upcoming season. You see them all there. Thank you so much for all of your support. And a special thanks to the presenting sponsor of today's program, Accenture, as well as our spotlight sponsors, Baker McKenzie and OCC. A quick technical reminder that you can submit questions to Steve and our panel today using the Q&A button at the bottom of your screen. I know that they will do their best to get to as many questions as possible. They have a lot to talk about. Another quick note, if you should run into any technical issues during the program at all, just email programs@executivesclub.org and members of the team are on by to assist. On to our program today. Part of the club's mission is to provide a platform to amplify thought leadership and critical messages with the business community in Chicago. Our annual Tech Outlook program focuses on the happenings in the tech space. This is our 6th year. It keeps getting better and better. We have a lot to talk about given Chicago's exciting trajectory of startup success. Chicago is now home to 20 tech unicorns, I think. I'm sure Steve will correct me if I'm wrong on that, with, I hear, 10 of them being made in 2021. So a lot happening. Here to say a few words before we get started, I'd like to introduce Michael Young, Global Lead for Accenture's software engineering business. Over to you, Michael.
Thank you, everyone, for joining us today for the Exec Club Tech Outlook for 2021. And so I think we're going to have a very exciting discussion with this panel about where the market is going, where investment dollars are going, and what's hot. And when I think about what's hot, I really like to think about how do we use these hot technologies for real business outcomes. And so I'll just give one example. There's a lot of discussion today about edge, Internet of Things, artificial intelligence, and how we can use those technologies, right, as a business to create new products, to create new user experiences, to create even new lines of business. And we worked with a cruise ship company to totally reimagine how they use these hot new technologies to change the experience for their cruisers, so that the boat essentially has become a smart home with Internet of Things, where there are all over the place, there are sensors, where you have an armband and you can use that armband, right, to be able to get yourself into the hotel room, where there's artificial intelligence on the boat and it can tell, hey, Michael Young, yesterday you actually ordered your Mai Tai and went up to the Lido deck. We'd like to proactively offer that up for you today. And bringing this all together, all these new technologies together in a new experience is really making a difference for several of our clients. So as Steve and the team talk about what's hot, what's going on in the market, I encourage all of us to think about how we can apply some of these technologies for real outcomes for our businesses. Margaret, back over to you to introduce our speakers.
Thank you, Michael. So everyone, please join me in welcoming our panel today, some of whom I am honored to call friends. First, we have Sach Chitnis, who's the co-founder and partner of Jump Capital, Hershenson, co-founder and managing director, Pear Ventures, and Dana Wright, managing director, Math Venture Partners, and Steve Kaplan, faculty director of University of Chicago's Polsky Center for Entrepreneurship and Innovation, will be moderating today's program. With that, I invite you to sit back, maybe eat some lunch, and Steve, over to you.
Great. Well, thank you, Margaret, and thank you, Michael. And welcome to Dana, Sach, and Mar. And I should add, Mar is our representative from the Bay Area, and I should let you know that Forbes every year ranks the top 100 venture capitalists in the world on something called the Midas list. And this year, Mar was ranked 29th in the world as a VC. And so congratulations to Mar.
Thank you.
And,
well deserved.
Thank you for coming. And we're going to look forward to hearing what she has to say. And hopefully Dana and Sach will be on that list in the near future. So we're hoping for that. So what I'm going to do is I'm going to start off with showing you some data, and then we will move to questions. But last year, I think you might recall that we were talking about being in the middle of a golden age of tech investing, and that VC returns were likely to be amazing this year. And that turned out to happen. This was the in the Wall Street Journal, actually less than a month ago, and about university endowments, which are big venture capital investments, doing spectacularly. If you read the paper today, or maybe it'll be tomorrow, a lot of big endowments announced their returns this week, including Yale, and the returns were spectacular. So what we're gonna talk about today is, will this golden age continue? And I'm just going to show you some of the data that shows you we are indeed in the middle of a golden age. So first of all, in terms of stock performance, this is public companies. And I don't know whether Accenture might be on this list under tech. They certainly should be. Technology this year continues to outperform everything else. The iShares technology is up more than the S&P. And since January 2020, it's spectacularly up 75% versus the S&P at 36. And then you look at the IPO market, and this is from PitchBook and the National Venture Capital Association. And exit values in the first 3 quarters already are the highest ever. So it's, and we have a quarter to go. So it's just amazing. And then let's say, well, you have SPACs, you have IPOs. And so again, just the numbers are huge if you add SPACs to the IPO market. And this is returns. So this is a long look at IRRs of funds that were raised, in a particular year. And the red is median, the black is the average. And you can see, it keeps skipping on me, there we go, the dot-com era, where you had these spectacular returns. Then they were terrible for a while. Look at where they've been in the last several years. The average venture fund since 2010 has been having returns of 20% a year or more. And the more recent vintage is 40% a year. That's annualized IRR. And if you look at your multiple of investment, how much you make for every dollar you put in, what comes out, it was like crazy in the dot-com era. Then it was crazy bad. The funds that have been raised post the financial crisis, the ones that are mature, it's like 4 times your money. That's unbelievable if you're an investor. And the more recent ones, 3 times, but they're not mature yet. So you see just wonderful performance, and this is why those endowments had such good years. And then I'll show you a couple other ways of looking at this. This is something called public market equivalent, where this tells you how you did in a venture fund compared to how you would have done if you just put your money in the S&P 500 or the public markets. And what's astonishing is those numbers. The average fund has been beating the S&P 500 by 60 to 100% over the last 10 years. And that's cumulative. So it's every dollar I put in 2012 funds, I made $2 compared to putting it in the S&P 500, which also went up. And the other thing that's amazing is that the median fund has very much outperformed the S&P 500 as well. It used to be people said you had to be just in the top quartile. Turns out you're in venture, you did very well, even with the median fund. And the Russell 2000 is even better, which is probably a better comparison because they're smaller companies. And then I'll tell you another look. If you want to annualize it, the annualized numbers are something like 10 to 20% a year better than the S&P 500. So this is just a way of saying the performance has been spectacular. And that's why, again, these endowments are reporting really good numbers, or the best numbers probably ever, because it was a wonderful year. And this gives you a look of where we've been in the last year. The red is where we were before the pandemic. And this, again, this is annualized performance. So venture was running 5% a year better than the S&P 500, which is pretty good. Then last year at this time, where we were saying we were in the middle of a golden age, it was running like, 10% a year better. And then look what happened in the last year, particularly the funds of this vintage, which is where Dana, Mar, and Sach are, because their funds are still there. It's like these funds are just popped up by another 5 or 10% a year relative to the S&P 500. So I probably have talked too much, but performance has been great. And what about investment? I'm sure Dana, Mar, and such probably are happy to see this because they're part of it. And anyway, so what about investment? So actually now, and this is a challenge, money is coming in. So the new record, first 3 quarters of deal value and deal count. And again, the 2021 is just 9 months. These other ones are the whole year. Then you've got, so deal count is a record, dollars are a record, and valuations are going up. This is early stage valuations. Median has gone up to 45, which looks like a record, and later stage valuations are higher. So we're going to talk about, looking backward and looking forward, what is happening. So I'm going to stop there. And just to conclude, we are in the middle of a golden age. Returns have been great, but investments are big. And so now to our panel, and I'll stop talking and we'll get some comments from our great panel. I want to just first take a look at Chicago. And I think, Margaret said 10. I think we've had 12 unicorns this year in Chicago. And Cranes also just reported that Chicago companies have raised a record $5.5 billion this year, again, as of the end of the third quarter. So it's not over. So Dana and such, is Chicago indeed doing well? Is that correct? Dana?
Yeah, I mean, you definitely see it across the board as the charts demonstrated. And so I think what happened with Chicago is there were a lot of investments that were made back in 2012, 2013, 2014 that really hit that acceleration of growth during the pandemic. And then we also were overly weighted to some of the transportation and logistics companies as well. And so you saw a lot of that coming in. And so part of it was Chicago's been planting these seeds for a long time. Part of it is kind of how we're weighted to different industries. And part of it was, in my opinion, the acceleration that COVID brought.
Such?
Yeah, I mean, just to reaffirm, it's been absolutely incredible. As with the math team, I started Jump almost 10 years ago. So I was investing in Chicago before it was cool, right? And I would say that the COVID impact for Chicago, put the health concerns aside, really has been pretty instrumental, right? It was a flyover, city when it came to tech in no uncertain terms. When people are not flying, they're not flying over. And Zoom has made it so much more efficient. People are looking at stories and problems that are solving real industry problems and listening to founder stories and metrics a little bit more homely. And so when you can convey that in a Zoom meeting, you're able to, get funding. And so what you found is that a lot of VCs that may or may not have been focused on companies outside of the coast have really just sought out really great problems, really great founders with good metrics. And Chicago certainly had plenty of those.
Interesting. Now, Mar, you're in the Bay Area, so are we fly over or fly in or zoom in now? What how do
zooming in? Yes. Well, thanks for having me here. First, I'd like to say that I think the pandemic has made us all more global. We actually, I think all of us have our first meetings over Zoom. It's, I think, very rare now to have a first meeting in person. And it's really hard to tell whether the person is in Chicago, New York, Hawaii, or a national park. we really just don't know where they are. They put a background and we just don't know, right? So, so I think that has made all of us in the Bay Area invest farther away from home, right? And now we're all surprised, like we have to fly to see these people. So that's number one. You know, I would say that another thing that happened here at the beginning, as you saw from Steve, the prices have doubled in 12 months. They literally have doubled, which is a big deal. So I don't hear that anymore, but earlier in the year, I heard a lot of people, a lot of investors, my colleagues say, well, I'm going to the Midwest because I can find really good deals there. You know, the prices are lower. So, you know, I don't hear that anymore. So it might be that the Chicago prices have caught up.
It's all relative, Mar. Yeah, it's all relative.
So, but yeah, it definitely has democratized a little bit the investment, like, you know, landscape. And there are great people everywhere, right? It's not just exclusive to here.
Yeah, a couple other geographic things. We always used to say you can, if the buy-in multiple is lower because it's in Chicago and the exit multiple is global, then obviously you're going to get some arbitrage on the investments that you make. And so that's one thing. But I think that has kind of compressed as everybody has gone remote. I think that is, well, we're always like, oh, okay, well, this remote thing created a situation where the Bay prices actually came to the middle of the country, and also the war for talent. And while we're talking about Chicago-based companies, it's really hard to tell whether a company is even based in Chicago anymore. How do you tell? Especially some of the new companies are starting from the ground up, and you've got employees globally and a remote first culture. You know, I don't even know if they're in Chicago anymore. And that's okay. It's a different kind of structure, but I think our whole view about where a company is based is going to shift slightly.
So is that, and that's true for all three of you? You think that that's the future? It's going to be distributed. You're going to do stuff, some on Zoom, some on person. How is it going to be in the next year or two, as things hopefully become less, you know, I should say more normal? What's the new normal going to be for you?
Yeah, I mean, they say, why do you rob banks? You go where the money is. You go where the companies are, right? If the good companies are in Chicago, Albuquerque, Austin, or San Francisco, you're going to go there. So I think it's more about the balancing act of this hybrid kind of culture of going to places where you can find the talent. I think that you're going to see an increasing, and we've seen that firsthand, increasing amount of talent just locate where they feel comfortable on a personal level, and then building the companies around it. So yeah, I think for sure it's going to be an environment where you're investing through Zoom, through visiting locations, but I think it's going to be definitely a balancing act there and distributed.
Yeah, I would say we're definitely closer today to Austin or Chicago than we were 18 months ago, right? Because we're okay getting on a Zoom. It's totally okay. I'm not gonna fly if I don't have to. So that's great. So I totally agree with that. There's gonna be more companies that are not in the Bay Area. The other question though is about whether you can make this culture of remote work when you are starting at zero, right? When you're 2 or 3 people, can you have a company where there are employees in 3 different time zones? And I find actually that's really, really, really hard. It's possible when your company is 30, 50 people, you can start thinking about that. But at the beginning, there's so many iterations and you need those whiteboards and those sessions in person with your co-founder. So I'm really not for building remote when you're really, really small, right? It's just very hard to make it work. It requires a lot more effort.
Interesting. Very interesting. Well, time will tell. Does that mean
time will tell?
The Bay Area is going to be less dominant?
I don't want to be on record for saying that.
Okay, it's being recorded.
Because
Don't
the
answer.
natural
Don't
conclusion,
answer.
yeah, no, yeah, for sure. I mean, we're seeing that, right? It's already happening. I think a lot of the venture money still here, especially those big growth rounds, et cetera. But for sure, it's spreading out, no doubt.
Interesting. No, and we've been the beneficiary of that, where Chicago has this year. Interesting. Okay, let's shift now to some general questions and more forward looking. Michael talked about edge. He talked about IoT, AI. He didn't mention blockchain, although that's also a way businesses are using tech. So what are the hot sectors now? Where are the three of you looking or seeing interesting things? So where are you, putting in your time? What should our audience be thinking of? So let's say I started with Dana. We'll start with Mar on this one.
With me? Okay. Well, we are, I'm really interested in climate change technologies, and that spreads a lot of things from actually growing food to, big energy. So it's a broad area of investment, very multidisciplinary. I do think there's going to be a tremendous need over the next few decades. So we're actively looking at that. We've been doing a lot of crypto, which it sounds crazy, but that's I think we made a decision about a year ago. It's either we get on the boat or we're going to be off the boat. So we invested in it. We have people in the team working on it. So that's something very active for us. And the last thing we've spent a lot of time is on, the redefinition of what it means to be employed. A lot of people want to make money off their hobbies or passion or not work for anybody. So a lot of exciting companies in that space, and it actually, generates a new sort of workforce. So generally those areas, but any great company is okay for me. Doesn't matter.
Okay. And they probably heard you in the audience. Okay, very good. Or they should be listening. They're any great company. Sach.
Yeah, I mean, we're a thematically driven kind of firm. So I'd say there's three major trends. One is this fragmentation in the fintech world, but it's really across the board of your relationship with financial companies, that fragmentation of wallet, if you will. So the premise that I had one relationship with JP Morgan, my bank account, my mortgage account, my wealth management has now become where I have 3 crypto accounts. I have 3 or 4 brokerage accounts, one for trading, one for day trading, one for wealth, and you get the gist. So that area for us is super enticing. 2 is crypto. We've been investing in the space for 7 years. We have a 4-person team dedicated to it. So we're beyond bullish on the opportunities there.
You're on the boat. You're on like a aircraft carrier.
Yes.
I think the 4 people on my team have 4 different speedboats, and they're just going independently. It's even worse. And then 3, I'd say, is the future of commerce and media, and more specifically, the changing behaviors of consumption. So the entertainment bucket has changed from just watching, your, Comcast, cable to streaming, but it also includes now trading. It also includes sports betting, and there's a variety of other things evolving. So it's a very fast and very highly competitive for your eyeballs, gaming and iGaming at casinos, and there's a lot of things emerging, and certainly the regulatory walls and taxation kind of regimen is certainly going to enable or hamper that, but we see that as an opportunity too.
Interesting. Dana?
Yeah, so I'll answer it 2 ways. I think math is a generalist firm. So we are across a lot of broad categories, but we do focus on companies with real revenue and real customers. And so we are always looking at what is the edge in customer acquisition. And so that is, how are some of the new technologies? What are the customer acquisition strategies that are unique in today's world? So I'll give you an example of that. we brought on somebody new in the Austin market that is going to do a deep dive for us on building community as an acquisition strategy. That's something that's been around for a while, but there's a lot more of that right now. And there's a lot more about just kind of how does building a community, whether that's in your customer base, whether that's a consumer side or whether that's a B2B side, how does that really drive customer acquisition? So that's one example. Another example is that because we're generalists, we tend to partner with other we're generalists and we're an early stage firm. We tend to partner with other firms that are specialists in certain areas. So one area that we're really interested in, but we haven't done very much yet, is just kind of Web 3.0. So the whole idea of things being more distributed and kind of what's coming next. And so we're starting to put some resources really around that whole body of work to understand where does that intersect with our thesis around customer acquisition and building real companies. So those are a couple of thoughts.
Very interesting. Now let me ask, there are two crypto people here. What does crypto mean? Does it mean that you're like buying Bitcoin and Ethereum, or does it mean you're doing something with it? How do you use it? So again, going back to Michael's earlier remarks about what does business do with it?
Yeah, I think to unwrap your question, there's how are we investing and is there utility, right? I would say we are, to use the baseball analogy, since we're in the playoffs, it's not even early innings. It's like we're in the batting cage right now, right? It's so early that the ideas are way in front of the actual utilization. Right now, it's frankly a trading instrument, right? There's a lot of infrastructure being built. But if you think about it, a lot of people use the phrase that it's going to be the next internet. And I think that's actually diminishing it, if you will, because it's going to, in many ways, not just be the next internet, but replace the financial systems and the capital markets. There's a lot of ambition that is much more broad than just being a mechanism of transfer of information or value. So that's maybe just on the utility. I would say very early innings. I think that a lot of our investments are around the infrastructure layers, the technology to enable it. And you have to have a very long-sighted view. You just cannot look at this as a near-term execution engine. It's more akin to what I would equate to like more the natural sciences and biotech, where you have to have a longer vision of where this can go and the patience. On the flip side is how we're investing. We don't invest in public coins. We play in the private markets. We're investing in ideas, white papers, all the way through protocols. We have a handful of thesis areas that we're hunting in, but I would say generally speaking, we are global. I mean, 70% of our crypto investments are outside of the US. And that's what's so interesting about the crypto space is the companies are so much more efficient. They're moving incredibly fast, but they're absolutely everywhere, right? And we are investing in companies in the Middle East to Venezuela to Nigeria. And I mean, that's I'm giving you extreme examples, but that's just to be hyperbole here, right?
Mar, and you, anything to add to that?
No, I'm very impressed because you were asking me about investing in Chicago, but he's investing in Venezuela. I think that's much more ambitious than that. But yeah, listen, crypto's, like you said, really early, Sach. It's also really crazy. If you think about the golden age, it's kind of the craziest age. Yeah, I think companies, I don't even know, 5x in valuation within a couple of months, and there's multiple, term sheets. And anyways, it's completely crazy. It feels a little bit like the .com right now in that space.
Oh, interesting.
It's really, really out of control.
So
and I mean,
and there will be great companies built, right? There will be great companies. It's just everybody there.
I think it's a great analogy. I mean, obviously there's a lot to be discussed about whether there's bubbles in the crypto space, whether it's irrational. I mean, for us, we look at it as asymmetric returns, right? We have a portfolio of core investments in software companies, consumer-based companies that'll do what hopefully all your charts are showing, really nice returns. But if this becomes the next internet and we have a couple new Googles, that's fantastic. And along the way, if we get those 5Xs because they just increase in value so quickly, hopefully we can, also invest in the broadcast.coms that we get out before the bubble bursts, right? So there's the uniqueness for venture to invest in crypto. What people don't appreciate is that most of these are in tokens. Most are not equity. And because they're tokens, once they're publicly listed, they're essentially liquid. So the premise that you're going to be waiting for 7 to 10 years for a public offering in the traditional world has now compressed to 1 to 2 years in the crypto world. So it's just another unique angle that has unique IRR and kind of, other kind of venture oriented kind of measurements.
And I would add, I think that is happening more and more in the venture space. There's all sorts of opportunities now for secondary trades that are starting to happen. So not necessarily from a tokenized perspective, the way that you're talking about it such, but also from the standpoint of just the ability to get in and out of positions in a more efficient manner. And I've been speaking with quite a few platforms, that are continuing. We've all seen them, but quite a few platforms that are continuing to really invest in that space to make it easier to provide liquidity along the way and more opportunities for investment along the way.
So that's sort of another question is I have two, but I'll ask this one first. Early stage versus later stage, because you're all early stage folks, and the later stage people are the people Dana, the Tigers and the Cotus that Dana mentioned. Is that are the later stage people out of control? Are the early stage people out of control? Where is there is there a sector that's overvalued or in a bubble right now that you're worried about? That was two questions. That was sort of two questions in one.
Those are like third rail questions, right?
Right, early, later, and then which sectors are you would you think are maybe overhyped versus sectors that aren't? And I guess you sort of said crypto. You have to be careful.
I said crypto.
Yeah.
I mean, I think if you see the multiples on both early and late, they're all kind of the same, about 2.5x, right? That what it was pre-pandemic. And you look at the IPO market. I mean, you showed the charts. We've also done really well. So, and that's the ultimate guide. So I think the prices are higher, but the opportunities are higher, right? How many 10 billion IPOs were there in 5 years ago? Just not that many, right? And today there are. If you don't have a $10 billion IPO, you almost don't want to advertise it. So it's what it is, right? So I think the justification for those prices holds. I do think that crypto has a lot of more noise than the traditional people. There has more noise. I think it has more opportunity as well, the same way that Sach was saying, there's going to be 2 Googles and maybe 1 Goldman Sachs, I don't know. But there's a lot more people in it, and how do you find them and how do you pick? It's much harder.
Interesting. Any other sectors that? Sorry, go ahead. Go.
Oh no, I was going to say there's kind of 2 questions that you based it on. One is there's an influx of capital, and I'd say there are 2 pieces of that. In the early stage side, I mean, how many celebrities do we know that started venture funds, right? I mean, there's a lot of early stage capital percolating ideas. And again, good, bad, I won't distinguish between specific names or the like. On the other end, you have a lot of names you mentioned, the Tigers, the SoftBanks, the Cotus, the Head of Sophia's, et cetera. Fantastic firms in various ways, but they're hedge funds and alternative capital that really didn't spend a ton of time in venture. And we're seeing increasingly coming earlier. So to say that they're late stage, I think maybe to some extent a misnomer. I mean, I think just loosely, I think between that list of 3 or 4, there are probably a dozen of our companies. And so it's not like we're shy about working with them. In fact, we proactively like it. But so you're getting it on both sides. And I think you're seeing a gap in the middle. And that's where hopefully I get to play a little bit more freely. But it certainly is pretty rich on both sides. I would say that, like, from a market perspective, you're asking, is there a bubble within a bubble, right? I do think that where you're seeing a bigger gap and bigger concern from my view is that these valuations, when they're so far ahead of execution, the ability to catch up, right? I think that you have like the premise that you're getting a valuation that maybe 2 years ahead starts feeling a little rich, maybe 3 years ahead in some instances. So that's where I get more concerned, less so that's more that attribute versus the specific industry that they're in.
Interesting.
Yeah, and I would add that I think the folks that you were talking about that are coming in kind of late stage, to Sach's point, is they are coming earlier, but they're taking an approach that was usually reserved for the very early stage and applying it to the Series B. So we like to call that spray and pray. They're just putting a lot of money to work in a lot of different companies and creating indexes of those companies, so that when one or two of those companies really make it, there's the opportunity for them to have it. So they're creating almost a new way to invest at that level that may or may not be helpful. It's putting a lot more capital to work in the system. And then we're going to have to see how the entrepreneurs choose to use that capital. So these are spray and pray philosophies, putting a lot of money to work in a lot of different companies, not taking board seats, not helping them from any strategic value, just providing additional capital and gasoline. So it's going to be interesting to see how the entrepreneurs respond.
I do want to say one thing about our industry, which is that, venture is more than money, right? I mean, I think there's a lot of company building that happens behind the scenes, and, really working with the founder, right? So to build that company. So if you take that money that is not involved in building company too early, I think it's harder to be successful. So that's just one caveat. And I think it's really hard for a founder when they get a term sheet with little diligence, 40 million at 2x, whatever venture pays you from one of these players. It's really hard for founders to say, no, actually I want somebody to help me build a company.
You have a very biased panel. You have 3 people that are very honed in on that attribute as a value add. So I totally agree.
That's what's happening.
I mean, you may remember back in the .com boom, a lot of these people came in, and then there's this line that the tourists always go home. That they're the tourists and they will go home at some point, but it may take a little while. So very good. So it's interesting. So that sort of suggests like the record investment pace is going to continue because there's a ton of money. And the question is whether are there more opportunities today? Is there a way to use the money, or is there too much money? Do you have a view on that?
I actually think I'm very optimistic long-term, right? If you want to invest in tech, I didn't even mention healthcare and biotech, where we have a lot in the portfolio, and that's also incredible, right? But I'm very optimistic. Like if you think of what the world will look 10 years from now, will there be more tech or less tech? And are we going to use tech to solve our biggest problems? The answer is a resounding yes, right? So there may be, I think you can look at the largest companies in the world today. I think 9 out of 10 are tech companies, where 10 years ago it was maybe 2. I don't exactly know the numbers, but it's completely different, right? So, hey, will there be some adjustments on the way? Absolutely. Is it going to happen next month? I don't think so. Is it going to happen a year or 2 years from now? Maybe, but I think it will happen at some point. There'll be some adjustment, but not in the long run.
Yeah, I mean, we're continuing to be very active. So completely agree. If anything, our pace has actually accelerated. Just the conviction. I think companies have also, during COVID, honed in on what matters, really honed in on building good companies, and have accelerated, frankly. So if we're seeing companies very capital efficiently get much further along. So where we were a Series A and B fund, we write $4 to $10 million first checks. We're writing the same check and we're coming in earlier, and the companies are hitting pretty close to the same revenue. So it's a very unique circumstance. The one anecdote I'd give, and I was walking with my wife, walking our dog with my wife, I should say, and talking about money, and more specifically, like, where do you put money these days, right? And I used a very crude version of, Steve, your PME, right? The public market equivalence. I'm like, do I want to put it in the public market, or would I rather put it in venture? And the answer is venture, right? If you're looking at where the opportunities for disruption are, where are you betting on, and again, excuse the analogy, but JP Morgan or JP Morgan buying these startups to really transform their industry? And so certainly, I think that it's hard to believe that there's a better place to put money. And I think that's part of why I don't think you're going to see this slow down anytime soon, is because the money from the pension funds, the hedge funds, and the like will continue, let alone, just because the alternatives to put capital to work are not as attractive.
And I think one of the things you said, Sach, is totally right, that today is the easiest it's ever been to scale a company, right? As soon as you find that product market fit, when I started my first company 20 years ago, you actually had to call a PR agency, right? And today it's like you have this amazing machine to advertise, but you have to build this acquisition engine. It's just when the thing works, you grow really, really, really fast. It's only a matter of how much money you can put in. That has to work.
And to be a little contrarian, I think the best investments are sometimes the ones that aren't hyped, the ones that a lot of people aren't chasing. And so to be a little bit contrarian, if you're going where everybody else is going, that's probably an area that's going to be overinvested in, and you may get lucky, or you may pick a few areas where the hype cycles aren't going. Maybe it's an unsexy business. So we're talking about IoT and some of those areas being applied to industrial businesses that still need to really have the efficiencies that some of these early stage technology companies are getting. There's a whole bunch of companies applying that to unsexy industries that I think are also an opportunity, that maybe they don't have the same hype cycles that some of the other things that we've been talking about today have. And so that's a real opportunity for investment as well.
So if I can summarize, it's kind of like, you have to worry. Expected returns are tricky everywhere because the public markets expected returns aren't so great either. And there are a lot of opportunities because of the technology in a lot of areas. So, healthcare, IT, bio. And so you're basically optimistic. That's very interesting, not surprising, but very interesting. There was one of the audience, wanted to ask this, and I was going to ask it anyway. So you're kind of positive, and overall, what scares you, or what are you most concerned about in the next year or two?
So I can think of two things. One is, do you believe the current multiples will last forever?
Okay.
And so when we're making those investments, we've always got to think about, okay, how far along, can the companies get, using that capital, and where will they be at that exit point? So to Sach's point earlier, people are accelerating and are able to go faster once they get that product market fit. So if they can drive into those valuations, good. If they can make better progress on the revenue side of that multiple, great. That's what we like to see. So that's just one concern, is, will the current multiples last forever? I think there could be something that changes that up, and it might not be across every category. It might just be in some categories. So I think that's the thing. And then as our companies take capital, we're coming in early, and then there's more capital that gets layered on. What we're really trying to look at is, again, how are those entrepreneurs spending that capital? Mm-hmm. And so if somebody is, maybe it used to be 3 or 4 rounds of capital at multiple proof points until they got ready for a bigger round. And all of a sudden at the early stage, somebody comes in and gives them $5 million up front. Well, that is fine if they spend that money the same way, getting those same proof points that they would have gotten it before. But if they are, if they're worried about going faster, if they're worried about scaling before they actually hit those proof points and get the business model right, then they'll burn a lot more capital.
Like we work.
That's an example. Yeah. I don't know that the unit economics ever really made sense on WeWork, but yes, but yes, that's the case. It's what are we scaling? So we're really in the business. Math is, and I think my colleagues are pretty much the same, are really in the business of helping them get those building blocks put in early and get those solid before they scale. Even if they take the money now, how do we make sure the unit economics, the customer acquisition strategies, that everything makes sense? And then, okay, I have three. The last thing that I'm really, really worried about is talent. And across the board, our companies, there is a war for talent, and it's not just in the company. And I'm not just talking about for our companies. I'm talking about systematically people taking less revenue because they can't service their customers. And that's happening across the board in a lot of different industries. And so that coupled, it's just another supply chain. So everybody talks about the supply chain risks. It's just another supply chain risk in terms of the talent supply, but it's impacting companies in a big way.
Go ahead, Mar. Yeah.
What I do, my worries, it's going to be my therapy session. Well, listen, for me, the biggest worry is that it's picking companies is much harder than it used to be 10 years ago. There's a lot more companies, there's a lot more investors. So investments are getting done much faster. You used to have 3 weeks to get to know a founder, do your diligence, and today it's days. And we've reshuffled how we do diligence internally and how quickly can we get to a yes. But I'm always reevaluating, are we doing it the right way? And this goes back to what you say, Dana. There's a bunch of people that are indexing the market, both at every stage, Series A, B, C, it doesn't matter. And those people don't need to do diligence because they're just indexing the market, right? So how do you compete with those folks and make sure you're doing your job? I think that's a big concern. The second for me is really talent, but I'm going to be even a little more selfish. I think talent for Pear. How do we grow our team? This is there's a lot of opportunity. I think we would invest in more companies if we had more capacity. Relates to the first point. But it's hard to become a great venture investor. You need time, you need the attention of somebody in our team. It's not something you can just kind of learn on your own. So, there's a certain rate of growth that we're limited. So that's the second one. I will tell you though, we had a lunch a couple of weeks ago with about 10 investors. You can see them because we posted a picture on Twitter and we asked what's the biggest worry you guys have? And you may not guess what's the biggest worry, but I will tell you. The biggest worry was China attacking Taiwan. That was the biggest worry. So if that's, how is the world going to change dramatically? You can think of that as a big one. So anyways, it's a macro.
No, that's right. The semiconductors could disappear.
Yes.
So that would be bad. Sach.
Yeah, the two I had, one is talent, and I won't reiterate that because I think the only thing I'd add is people look at unemployment numbers and but when you're looking for skilled labor, more specifically developer talent, it is incredibly difficult, regardless of geography. So the premise that Amazon comes in and pays 2 to 3x, and I'm not exaggerating, and then let alone startups with well-heeled balance sheets stealing from other startups. So talent is an incredible problem, and I've had the same issues as Pear as far as adding to the team. It's a very competitive market. The second one I'd say is expectations, and for me, I think it's again, when you move the goalpost with a new valuation, there are new expectations, both for the team, for the investors, and the like. Candidly, the charts you showed are a different set of expectations, right? Do I want my LPs seeing 30, 40% IRRs as the expectation going into whatever economic environment we're going to have in the next 2 to 3 years? The answer is no, right? I'd like to set those expectations low and exceed it every day of the week. So, but I think for the startups, it's one of my worries. We have a portfolio of very well capitalized businesses right now that have high expectations. And so achieving those requires a lot of execution.
Interesting. Very interesting. There are a couple of questions, about supply chain and inflation. Does that affect you? So talent I get, but supply chain or inflation, does that worry you? Does it affect you? Can you fix it in things you're doing, or, any thoughts on that?
I'll just make one comment. We don't invest in direct product businesses. So like things that actually sell widgets or actually do value, we'll say more generically. We invest in people-based businesses selling software, right? And I would say, I came at a board meeting recently, I won't name the company, that their comment was their customers are impacted. And so as a result, they're seeing sales concerns, early indications. So meaning, and just to use as an example, if Target's shelves are empty, theoretically, and they don't do promotions to get people in the door, because why do promotions for that product when it's not on the shelf? That has cascading effects on the marketing industry and so forth and so on. So not directly in my portfolio, but I would say we're seeing the early indications, certainly.
Mm-hmm. Mar, do you see anything? I mean, that's in the Bay Area, because a lot of, business to consumer that sort of uses supply chain, no?
Yes, I'm personally affected. I can't buy a car, or my car has been on the wait list for like 6 months. Anyways, yeah, definitely. And we actually have a few investments on supply chain, transportation. I mean, I think the trucking industry is a big deal while we're not getting things out of our ports. So it's even a local problem, that it's going on. And again, if we would not be VCs if we weren't optimistic. So I think whenever I see a problem, I see an opportunity to invest and actually try to address it. So yeah, we're actually actively investing in the space. And I think there's a bigger issue, which is manufacturing, right? And where do you, back to the Taiwan question, TSMC is so far ahead from any US. I mean, it used to be, Intel was heads to head, so it's no longer the case. So how do we maintain our edge if we don't own one of the core technologies of what everything depends on, right? For example, that's one thing, but it could be it doesn't even need to be semiconductors. There's other things that we might need to figure out how to do here.
Okay, interesting. Let me, we've got a few minutes left. I'll finish off with related to one or two questions. ESG and things of kind of other than COVID that has affected how you invest. And ESG obviously is big in corporates. It's hitting private equity. Has it hit venture? And how do you, how has that affected you, either as your LPs, your companies you invest in, it's a broad question, but I figure you'll rescue me and have an opinion.
Well, we invest very early, Steve, as you know, and a lot of the founders that come in are actually not corporations or people, but they're very ESG aware, I would say, so they want to work on companies that are good for the environment, that have a mission, et cetera. So we're seeing a lot of, interest on those companies. And by the way, back to the talent wars, those companies that have those missions have a much easier time recruiting, because that's what the new, the younger generation wants. So anyways, and like I said at the beginning, we're actively investing on climate, environment solutions, which I think there'll be more attention and real, I mean, as you can see in California, there's so many fire related problems that, you know, we're going to have to spend money on it.
Yeah, I mean, maybe I'll add to, to build off of what Dana mentioned. I think she was mentioning that she has a new person on her team, thinking about community-based businesses and using that as a core strength. Our focus, we don't focus on climate or any of these specific areas, but I would say it's the community-based businesses we're very, very focused on. We feel like that's a very strong tailwind at a macro level, that whether it's community-based buying on retail, which is, people are using influencers to kind of guide them. It's also going to be the transparency of knowing whether the company or the product has, a very specific impact on the environment or the like, especially on social. And then two, like financial, like you're seeing this with Reddit, you're seeing this with all of these, community-based sharing platforms, maybe sometimes not pointed in the right direction, but it's an increasing focus, not only just to have the transparency on the companies you're investing in, but doing things as a group for good, and again, I think that is, you're going to see a lot of enablement companies focused on enabling companies to do things properly, to enable that transparency, and then like companies that are just, frankly, ESG oriented kind of transparency companies specifically.
I believe that we're getting ready to go into, we've been headed this way for a while. Mar said, every company is a software company. I believe every company is going to be an ESG company. I believe you're going to see the coming together of traditional, where we're not actually talking about whether it's ESG, it just is ESG, because everybody has to be focused on those solutions. And so I can make an ESG pitch for almost every company in our portfolio, even though that's not the way that they talk about their companies. And I think we're just going to see more and more of that as we move forward, and less sort of, and then at the later stages, maybe those companies are making those distinctions more. But right now, the early stage companies, like I said, I can make a pitch for almost every company in our portfolio, some sort of ESG focused, impact focus.
So does that mean, excuse me, all of you are impact investors?
In some way or another.
And are you hearing anything from, do you get any pressure from your LPs, or your LPs are just interested in returns?
I have not heard from my LPs.
They just want returns. I see. And
They're just busy counting all the cash that Mars is giving them, right?
Look, I think there is some pressure. I believe it's coming kind of at the later stages, and I think that the ESG only focused funds are coming. I do believe that there are some threads around that, but like I said, it depends on how you're gonna go about counting that, and how, what falls into it. So I was talking to a company last week, and he was telling me about he's very focused on getting more electric vehicles, and that was part of his entire pitch. And he was like, look, when I talk to the ESG based funds, they don't think I'm focused enough on it. When I talk to the other funds, they think that I'm too impacty, not focused enough on just the pure profit return. So he's caught in the middle of trying to navigate sort of this world. And so I think those distinct buckets actually end up hurting folks that are making big differences, but not doing that. He has two pitches now. He has a pitch for the ESG based funds, and he has a pitch for the other folks.
Very interesting. Well, very cool. We are at time. So I'm going to say thank you to our audience for sticking around. Thank you to Dana, Mar, and Sach for a great discussion. And it sounds like, we have just gone through a spectacular year that has brought lots of money, but there's lots of opportunity. And there are a lot of things, that Michael started us off with, of things for tech to do. And we expect to see more good things happen in the coming years. So on that positive note, thank you all, and hope to see you next year.
Okay.
Thank you, Steve.
Thank you. Thank you.